Welcome back to KP Data Investing channel. It's been more than a week since our last update. We have been very busy in the past week because we have been closely monitoring the markets and have made several changes to our portfolio. 2 new stocks are added to our portfolio. And today in this video, we are going to share our investment thesis in only one of the companies. Maybe we will share the other one next week. As you might have read the title of this video, you should have known that this is a home builder company. Before getting straight into the company and our investment thesis, why don't we begin by introducing the top leaders in this industry first, which we have got D.R. Horton, Lennar Corporation, NVR, Pult Group, and Toll Brothers. All these companies are all very well known and hold the largest market share in the home builder industry in the United States. In this graph, every one of us could easily observe the changes in the market share of these companies from 2011 to 2020. The company names we just have mentioned continue to dominate the market for at least a decade long. From here moving forward, we think that it is fair for us to say that these companies have quite a competitive advantage with a business moat. To discuss the housing market or homebuilder industry, we think that it is important to provide some background information by talking a little bit about the money supply in the market. Here, the balance sheet of Federal Reserve has more than doubled since mid-2019, from around $4 trillion to almost a whopping $9 trillion. This simply means that if you have $100 before the pandemic, the purchasing power of that $100 is now only worth less than $50. This is just an example illustrating how much money the Federal Reserve has added to the market. Or perhaps we can try to evaluate the increased money circulation in another way. The money supply M2, which is a broader measure than M1 that includes cash, checking deposits and other convertible funds, has increased 40% in just 2 years, from February 2020 to February 2022. This means the $100 before the pandemic is now only worth around $60. Can each of you imagine the significant decrease in your purchasing power in the past 2 years? So, what would you do when you have extra cash in the pocket? Some of you might buy stocks, while some of you might buy the hard assets, such as housing properties, to retain its value and hedge against inflation. This is exactly why we think that, as long as the leverage people use to buy real estate remain healthy, it will be difficult for any of us to see the price of real estates to fall off the cliff. Surely, many of us think that the housing prices or rent have gone ridiculously high. But we just want to objectively say that the prices might not be as high as most people think, given the massive amount of money printing. Right now, remember the 40% increase in the United States M2 money supply since the pandemic. Look at the housing price. The median sales price of houses sold for the United States have increased only 9%, from $374,000 in second quarter of 2020, which is the moment when the Fed announced unlimited quantitative easing, up to $408,100 in the fourth quarter of 2021. To provide a more comprehensive perspective, let's take a look at another angle using the U.S. Housing Price Index. The index has gone up 31%, from 285 in March 2020 to 373 in March 2022. All these numbers can be easily found on the internet. And these numbers have provided a more objective assessment in the housing boom in the past 2 years, under the context of the Fed increasing money supply at unprecedented rates. Finishing talking about the economic backdrop, now let's get back on track to our invested company. First of all, we wanted to discuss the difference among the top players in the homebuilder industry, but this will make the video very long. Because of that, we decided to skip that part and just briefly saying that our invested company was founded in 1967. They focused on building luxury homes for high-end customers. The average delivered home price is around $844,000, higher than their competitors, which are about $300,000 to $500,000. In addition to the housing price, the home buyers also added an average of $177,000 in lot premiums and upgrading their structural design to their homes. That's about 24% of the base price of their home. This is just simply outstanding. Our invested company have national presence in over 24 states and currently selling from 340 communities. To maximize the capital efficiency, all homebuilders use options to control their land rather than actual ownership. And our invested company owned or controlled nearly 81,000 home sites, a 28% increase from last year. Most of them were detached home communities. If you have read carefully into the details of our invested company overview, you would have found out which company this is. And yes, it is the Toll Brothers. They are the fifth largest U.S. home builder by revenue and one of the Fortune 500 company. In the left-hand side of the company overview, you could have seen that their revenue and earning per shares are increasing consistently in the past 5 years. One of the many reasons why we picked Toll Brothers out of all the homebuilders is because of their targeted wealthy customers in the wealthy urban areas. These customers' purchasing power are not the same as the normal working class. They are more immune to rising interest rates because they have higher incomes. The gap between the have and have-nots will at least remain the same as before. In their latest annual report, they said that approximately 18% of their home buyers paid the full purchase price in cash. Perhaps you could have noticed that in the extra 24% added options by the home buyers to their purchased homes. They are just having extraordinary purchasing power. Their current market cap is at around $5.5 billion with a price-to-earnings ratio at 6.6. They are paying out a 1.51% yield. Analysts are estimating their one-year target price at $65, which is about 38% upside. Looking at their fundamentals, another reason why we bought Toll Brothers is because of their shares repurchasing program. They reduced their weighted average shares outstanding at a 6.5% rate, from 175 million shares in 2016 to 125 million shares in 2021. The buying back of share outstanding can contribute to the increase on earnings in share basis, which is their earnings per share. We couldn't find the same repurchasing program in other home builder companies, such as D.R. Horton and Lennar Corporation. Also, their total debt-to-equity rate is the lowest in the past 5 years, down from 89% in 2016 to only 63% in 2021. The same goes to their total debt to EBITDA, also the lowest in the past 5 years, down from 7.16 in 2016 to 2.8 in 2021. They are reducing their debt and trying to improve their fundamentals. Given the market is a future discounting mechanism, we will also look at their growth rate. In 2022, they are expected to grow their EBITDA at 41% and earnings per share at around 53%. If we take this number and divide it by their current price to earnings, we will have a PEG ratio at only 0.13. Even though their expected growth rate in 2023 will diminish to 9% to 19%, this remains to be very attractive considering their current low price to earnings ratio. The PEG is still way below 1 using 2023 numbers. Not to mention their current free cash flow yield sitting at an insanely high number, which is 22% of their market cap or 15% of their enterprise value. This insanely high percentage of free cash flow yield could not be found in any other home builder companies. The high free cash flow yield will be able to help them to survive in any kind of unexpected events. In the end of March, we bought the stock at $50.3. And our strategy is to continue to average down the position whenever we find the stock is down every 15% from our purchase price. Our time horizon for holding Toll Brothers is around 1 to 2 years, depending on their return given to us. We don't think that this is a hyper-growth stock, but we can take advantage of the latest red-hot housing market to capture some nice and decent amount of return by investing in Toll Brothers. The market equilibrium of the housing market, balancing between the supply and demand, will likely return to normal in the next year or two. We have shared our investment thesis in Toll Brothers. Thank you for watching this video. Press like and subscribe if you think our video is useful. Comment below for stocks that you would want us to look into using similar approach. Hope to see you in the next video. Investing is for everyone.